Well, David, we had that rand trading as firm as I could see at 7:37 this morning. And of course, a bit of risk appetite coming back onto the table following those stress test results out on Friday. What do you make of those stress tests, David? Do you think the market goes ahead of itself? Because some investors are saying they don't appear to have been very stringent.
Yeah, I don't think they were stringent at all. The first thing that happened, Stephen, was that they are valuing only the bank's trading portfolios and left out what they call the buy and hold portion of the debt book. And what that does, obviously, is it removes a lot of the sovereign risk or the risk of a sovereign default out of the stress test. But nonetheless, I think what's happened is a lot of the banks have come through a lot cleaner than was anticipated. And what it does do is it sort of holds off the need to raise further capital for the moment, and that's taken some of the pressure, of course, of the banking sector and allowed markets to move on, and move beyond the sort of stress test, and everybody a little bit relieved that those are out the way, albeit not the most stringent tests in the world, one has to say.
Of course, the rand's latest strength started really after the Reserve Bank's MPC decided to keep interest rates unchanged on Thursday. We have seen it trading down as firm as 7:37, as I said a little bit earlier, but we did have that Reserve Bank leading indicator out a short while ago, and we have weakened up to 7:40. Do you think that's in response to that leading indicator?
I think more as a response to imported demand at this point, Stephen. We have come very, very far. We've headed down from the sort of mid 750s last week to trade sub 740. At these levels and around 740, we've seen very strong imported demand, and everybody now just in a holding pattern, waiting to see how equity markets are going to respond this afternoon.
Well, if we do make a break, sustain a break rather, below 740, where to from there for the rand?
Yeah, I think we're certainly in the 730, 740, 745 range at the moment. Things are looking very good from a risk appetite point of view. The VIX index has come down. Equity markets are fairly buoyant. The dollar is on the back foot. So for the moment, everything pointing to support for the rand. And there's a good possibility on what's going on at the moment on the back of the risk appetite that we may head towards the lower 730s, if not in the next couple of days, certainly by the end of the week, should the factors that are supporting it remain in play.
Of course, we have quite a lot of economic data out locally this week, David. We had that leading indicator out this morning showing negative growth for the first time since the beginning of last year with a contraction of 0.5%. But I suppose that must have been pretty much expected just given the loss of momentum we've seen in the economic recovery here.
Yeah, I think so, Stephen. We very much dependent on what happens globally on the international markets, and we did see in the second quarter certainly a lot of fears around economic growth emanating first, of course, out of Europe, and then the softer sort of picture coming out of the US. We've tracked that sort of data, but I think going back to the Governor Marcus's speech last week, the recovery is on track. Albeit we do have some danger signals and some uncertainty going forward. But I don't think the one number this morning that came out anything to be too concerned about.
Unemployment numbers coming out tomorrow. Of course, the last reading 25.2%. Would you expect any improvements in the unemployment situation? Do you think it's a bit too soon?
No, I think if anything, it's probably weakened slightly more, Stephen. That obviously, as we've been through the sort of global debt crisis and the concerns that's created, what we've seen is employers or potential employers concentrating on their balance sheet, and one of the first things that they do is, of course, concentrate on the costs. We haven't replaced anywhere near the jobs that we've lost. We haven't started to turn the cycle yet, and I guess, ironically, in any case, that's one of the things that's boding well for the rand, because our interest rates will be on hold at least until that economic recovery bites, and that's attracting the international investors for the moment.
Of course, we had Reserve Bank Governor Jill Marcus last week saying that inflation should remain within that target at least until the end of 2012. Currently 4.6%. That was the last reading we had for May. What are you expecting for June's figure when it comes out on Wednesday?
I think we'll see a better reading, heading towards the lower fours. But I think as the Eskom price pushes come through, the wage demands come through, that will obviously have a role to play. But inflation as a broad threat at the moment, really non-existent. And I think we'll remain in this band, but until the global, at least until the global picture changes or until we start creating some jobs.
Well, David, we have public sector's workers going on strike on Thursday, and the previous strike a couple of years back from the public sector cost the economy a few billion rand. Do you think we face the same? Do you think this could be potentially rand weakening at the end of the week?
Well, again, Stephen, the market is choosing to ignore domestic factors, and there's quite a lot of risks associated to that. We do have the ANC's General Council coming up in September, and they've tabled a few things on the agenda there that might be concerning. Obviously, the strike action that is taking place across the country, across all sectors, the wage demands that are taking place, these are all potentially negative. But the international market at this moment choosing to ignore them and focus on international factors, which of course at this point, as we stand right now, all really supportive for the rand.
Well, here's one international factor which looks quite interesting, and that's business confidence in Germany. We had that IFO index out on Friday, the biggest increase, in fact the highest level since German unification in 1990. And of course this follows positive German manufacturing data earlier in the week, so it looks like at least some parts of Europe are showing a strong recovery, and obviously aided a bit by the weak euro we had earlier in the year.
Absolutely, Stephen, and that's one of the reasons we're seeing the dollar on the back foot at the moment. In the last few weeks, European growth data, economic data has really surprised to the top side, while US data has been really, really soft. And coupled to that, of course, Europe has started to tackle their debt problems. The US hasn't even come close to really talking about it, beside Mr. Bernanke saying something must be done. And that's why we're seeing the dollar react the way that it has, certainly against the euro and the pound, and against the yen, and certainly against the emerging market basket. So data out of Europe really, really supportive at this point in time. Data out of the US quite soft. And the emerging market picture looking very, very strong, and hence we're seeing steady inflow into emerging markets.